In September 2008, the global financial system came within days of total collapse. Not a recession, not a bad year. A complete meltdown that could have frozen every bank, wiped out savings, and stopped paychecks across the entire world. Trillions of dollars vanished. Giant companies that had stood for 100 years died in a weekend. And almost nobody saw it coming. This is the full story of the 2008 financial crisis, the greatest money disaster of our lifetime, explained from the very beginning. To understand how the world nearly broke, we have to start with something that sounds completely harmless: the American dream of owning a home. For generations, buying a house was seen as the safest, smartest thing a family could do. Homes always went up in value, or so everyone believed. And that single belief, that house prices could only ever rise, is the seed from which the entire catastrophe grew. Hold on to that idea. It is the foundation of everything that follows. Here's how buying a home normally works. Most people don't have hundreds of thousands of dollars in cash, so they borrow it from a bank. That loan is called mortgage. The bank gives you the money to buy the house, and you pay it back slowly over many years with interest. If you stop paying, the bank takes the house. For decades, banks were careful about who they lent to because they wanted to actually be paid back. That caution was about to disappear. In the early 2000s, something changed in how banks handled these mortgages. Traditionally, the bank that gave you the loan kept it and collected your payments for 30 years. So the bank cared deeply about whether you could pay. But a new model took over. The bank would make the loan, then immediately sell it to someone else on Wall Street. The risk left the bank's hands instantly. And once you no longer carry the risk, your incentives change completely. Think about what that means. If a bank makes a loan and sells it the next day, the bank gets its fees and walks away clean. Whether the borrower ever repays is now someone else's problem. So the bank stops asking the most important question: can this person actually afford this house? Instead, it starts asking a far more dangerous one: how many loans can we pump out and sell? Volume became the goal. Quality stopped matching. This is where subprime mortgages enter the story, and they are at the heart of everything. A prime borrower is someone with good credit and solid income, very likely to repay. A subprime borrower is the opposite: weak credit, unstable income, a high risk of defaulting. Normally, banks avoided these borrowers or charged them very high rates. But in the new system, lenders started handing mortgages to almost anyone, no matter how risky, because they were going to sell the loan anyway. It got absurd. Lenders created what became known as ninja loans, given to people with no income, no job, and no assets. Some borrowers lied about their earnings, and lenders looked the other way, or even encouraged it. People were approved for houses they could never realistically afford. Mortgage brokers earn a commission on every loan they closed, so they had every reason to say yes and no reason at all to say no. The brakes were completely cut. Now the question is, who was buying all these risky loans from the banks? The answer is the engine of the crisis. Wall Street firms bought thousands of mortgages and bundled them together into giant packages called mortgage-backed securities. The idea sounded clever. One single risky mortgage is dangerous. But thousands bundled together? Surely they wouldn't all fail at once. Investors could buy a slice of this bundle and collect the homeowner's monthly payments as income. It looked like a money machine. Then Wall Street got even more creative and even more reckless. They took these bundles and sliced them into layers called tranches, repackaging them into complex products called collateralized debt obligations, or CDOs. These were bundles of bundles, so complicated that almost no one truly understood what was inside them. Risky subprime loans got mixed in with safer ones, chopped up, and sold around the world. The danger wasn't removed. It was just hidden under layers of complexity. But there was a problem. Big, serious investors, like pension funds, are only allowed to buy safe investments. They couldn't touch anything labeled risky. So how did all this subprime garbage get sold to them? Through the credit rating agencies. These companies are supposed to grade investments for safety, with AAA being the gold standard, the safest possible rating. And shockingly, they stamped AAA on these CDOs stuffed with subprime loans. Garbage was officially blessed as gold. Why would the rating agencies do this? Because of a deep conflict of interest. The agencies were paid by the very banks whose products they were rating. If one agency refused to give a high rating, The bank could simply walk down the street to a competitor who would. So the ratings got inflated to keep the business flowing. The watchdogs that were supposed to protect everyone had been quietly turned into cheerleaders for the whole scheme. There was one more layer of danger, and it would nearly destroy the world's largest insurance company. Investors wanted protection in case these mortgage bundles failed. So Wall Street sold them insurance-like contracts called credit default swaps. If your CDO went bad, the seller of the swap promised to pay you. A giant insurer named AIG sold a staggering amount of these swaps, collecting easy premiums, convinced the housing market would never crash. They were insuring a disaster they didn't believe could happen. So now picture the whole machine running at full speed in the mid-2000s. Money poured into housing. Anyone could get a loan. Prices shot up. People bought homes purely to flip them for profit months later. Everyone felt rich. Borrowers used their rising home values like ATMs, taking out more loans against them to buy cars, boats, and vacations. The party was deafening, and like every bubble in history, the people inside it were sure it would never end. But a bubble is built on a single fragile assumption, and here it was, that house prices would keep rising forever. The entire structure depended on it. As long as prices rose, even a borrower who couldn't pay could just sell the house for a profit or refinance. The risk stayed hidden. Every layer of this complex system, the loans, the bundles, the ratings, the swaps, secretly rested on that one belief. And in 2006, that belief began to crack. Housing prices stopped rising. Then they started to fall. And the moment that happened, the trap sprang shut. Many subprime borrowers had loans with low teaser rates that suddenly jumped higher after a couple of years. Their payments ballooned just as home values dropped. Now they couldn't afford the payments, and they couldn't sell for a profit because the house was worth less than they owed. Defaults began to rise. Then they began to surge. As homeowners defaulted, the mortgage-backed securities and CDOs built on those loans started to rot from the inside. Those AAA-rated investments, supposedly the safest in the world, began losing enormous value. Banks and funds around the globe were suddenly holding hundreds of billions of dollars of toxic assets that nobody wanted to buy. Worse, no one even knew exactly how much poison was inside each one. Fear and uncertainty spread like a virus through the financial system. The first giant to fall was Bear Stearns, one of the oldest and most respected investment banks on Wall Street. In March 2008, it was drowning in toxic mortgage assets, and panicked clients yanked their money out. In a matter of days, an 85-year-old institution was on the brink of collapse. The government helped arrange a rushed fire sale to J.P. Morgan Chase for a tiny fraction of its former value. Wall Street was stunned, but the worst was still months away. Next came Fannie Mae and Freddie Mac, two enormous companies that stood behind a huge share of America's mortgages. As losses mounted, they too began to buckle. They were so central to the housing market that their failure was unthinkable. So in September 2008, the U.S. government effectively took them over, putting them under federal control to keep the mortgage system from seizing up entirely. The crisis was no longer creeping. It was accelerating fast. And then came the weekend that changed everything. Lehman Brothers, a 150-year-old investment bank, was collapsing under the weight of its bad bets. The leaders of Wall Street and the government gathered in emergency meetings, desperately searching for a buyer or a rescue. But this time, the government drew a line. There would be no bailout for Lehman. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in American history. The earthquake had struck. The fall of Lehman unleashed pure panic, because all these banks had lent enormous sums to each other and were tangled together through those credit default swaps. No one knew who was safe and who was secretly doomed. So banks stopped trusting each other entirely. They stopped lending. The flow of money, the lifeblood of the entire economy, simply froze. This is what economists had feared most. Not one company failing, but the whole system locking up at once. The very next day, the disaster spread to AIG, that giant insurer who had sold all those credit default swaps. With mortgage assets failing everywhere, AIG suddenly owed staggering sums it could not possibly pay. If AIG collapsed, it would drag down every bank it had insured, triggering a chain reaction across the planet. So the government stepped in with an emergency rescue of around $85 billion, taking control of AIG to stop the dominoes from falling. The panic reached ordinary people in terrifying ways. Money market funds, considered as safe as cash, started to lose value. An event so rare was called breaking the buck. Savers feared their cash itself was no longer safe. Credit cards, car loans, and business financing began to dry up. Companies that needed short-term loans just to make payroll suddenly couldn't get them. The crisis was leaping from Wall Street trading floors directly into everyday life. The fear was becoming universal. The stock market went into freefall. Trillions of dollars in wealth evaporated as markets crashed day after day. Retirement accounts that families had spent decades building were cut nearly in half. People watched their life savings shrink on the screen in real time. The fear was not just about losing money anymore. It was a creeping dread that the entire financial system, the thing that everyone quietly trusts to just work, might actually stop functioning altogether. Faced with the possible collapse of the economy, the government proposed something drastic, a $700 billion rescue package to buy up the toxic assets and stabilize the banks. It was called TARP. The public was furious. Why should taxpayers bail out the very Wall Street firms whose greed caused the disaster? Congress actually rejected it at first, and the stock market instantly plunged in response. The pressure was unbearable. Eventually, a revised version passed. The bailout was on. Central banks around the world took extraordinary action. The Federal Reserve slashed interest rates to near zero and pumped trillions of dollars into the financial system to keep it alive. Governments stepped in to guarantee bank deposits and prop up failing institutions. It was the largest financial intervention in history. Slowly, painfully, the panic was contained. The system did not completely collapse, but the damage it left behind would shape the world for years to come. Because while Wall Street was being rescued, Main Street was being devastated. Millions of Americans lost their homes to foreclosure as they fell behind on payments. Millions more lost their jobs as businesses collapsed in the recession that followed. Unemployment soared. Entire neighborhoods filled with empty, foreclosed houses. Families who had done nothing wrong, who had simply lived their lives, were crushed by a disaster manufactured in distant boardrooms they had never seen. And it was not just America. The crisis was global. Because those toxic mortgage products had been sold all over the world, banks in Europe, Asia, and beyond were poisoned too. Countries like Iceland saw their entire banking systems collapse. Global trade shrank. The downturn became known as the Great Recession, the worst economic catastrophe since the Great Depression of the 1930s. One bubble in American housing had managed to shake the entire planet. Now here's the part that still makes people angry today. The banks that caused the crisis were largely rescued with public money, under the idea that they were too big to fail, meaning their collapse would destroy everyone. Most of the executives kept their fortunes. Almost none went to prison. Meanwhile, ordinary families lost their homes, jobs, and savings and got no rescue at all. That gap between who caused the pain and who paid for it has never fully healed. In the aftermath, governments tried to make sure it could never happen again. In the United States, a sweeping law called Dodd-Frank was passed, forcing banks to hold more safety capital, reducing their riskiest bets, and increasing oversight. Stress tests were introduced to check whether banks could survive another shock. The reforms were real, but debate still rages about whether they went far enough or whether the seeds of the next crisis are already quietly being planted. But here's something remarkable. Not everyone was blind. A tiny handful of investors actually studied the subprime loans hiding inside these securities, did the math, and realized the whole thing was doomed. While the entire financial world partied, they reached a stunning conclusion. The housing market was going to crash, and they decided to do something almost nobody had ever done before. Bet a fortune that the American dream itself was about to collapse. One of them was Michael Burry, a former doctor turned investor with a brilliant, obsessive mind. He read through the actual mortgage documents that almost no one else bothered to open and saw the rot inside. He went to the big banks and asked them to create a way for him to bet against these mortgages, using those same credit default swaps. The banks happily sold him the bet, certain he was a fool. They were about to be proven catastrophically wrong. For months, These contrarians looked insane. They were paying steady premiums to bet against a market that kept rising, bleeding money while everyone laughed at them. Some of their own clients were furious and tried to pull their funds, but they held their conviction. And when the housing market finally cracked and the mortgage securities collapsed, those lonely bets exploded in value, earning some of these investors hundreds of millions, even billions of dollars. They had seen the iceberg while everyone else danced. Meanwhile, as the system burned, a small group of officials were desperately trying to put out the fire. Treasury Secretary Henry Paulson, a former Wall Street titan himself, Federal Reserve Chairman Ben Bernanke, a scholar of the Great Depression, and New York Fed President Timothy Geithner. These three men spent sleepless nights in emergency meetings, making world-altering decisions on almost no sleep, knowing that a single wrong move could push the global economy off the cliff entirely. Their choices were agonizing and inconsistent, and people still argue about them today. They rescued Bear Stearns, but let Lehman Brothers die. They bailed out AIG, then pushed a massive TARP program through a furious Congress. Critics say letting Lehman fail turned a crisis into a catastrophe. Defenders say they prevented a second Great Depression. The truth is, they were improvising at the edge of the abyss, with no map and the whole world watching. The damage spread beyond banks and into the real economy of factories and jobs. America's auto giants, General Motors and Chrysler, were pushed to the brink of collapse as car sales evaporated. These companies employed hundreds of thousands of workers and supported entire towns. So the government stepped in again with a controversial bailout of the auto industry to stop another wave of devastating job losses from crashing through the heartland. As the dust settled, public anger boiled over. People watched as the same banks that took taxpayer bailout money turned around and paid their executives enormous bonuses. The unfairness was staggering. This rage eventually erupted into a movement called Occupy Wall Street, with protesters camping the financial district under the slogan, "We're the 99%. It captured a feeling that has never fully gone away, that the system was rigged to protect the powerful and punish everyone else. The recovery, when it finally came, was painfully slow. Unemployment stayed high for years. Millions of families who lost their homes never got them back. An entire generation entered the workforce during the wreckage, shaping how they would view money, debt, and trust for the rest of their lives. The economy did eventually heal, and markets recovered and even soared again. But the scars on ordinary people ran deep, and for many, they never fully faded. There's a detail the banks love to point out. In the end, the government's rescue programs were largely paid back, and in some cases even turned a small profit for taxpayers on paper. That's technically true, but it misses the real cost. The trillions in lost household wealth, the shattered careers, the foreclosed homes, the years of fear and hardship, none of that showed up on the government's balance sheet. The true price was paid in human lives, not just dollars. And the crisis quietly reshaped the world we live in now. It fueled a deep distrust of big banks and institutions. It influenced politics for years to come. It even helped spark the creation of new ideas like cryptocurrency, born partly from a desire for money that didn't depend on the banks that had failed so spectacularly. The aftershocks of 2008 are still rippling through our economy and our culture to this very day. So with the full story told, the players, the panic, and the aftermath, let's pull out the timeless money lessons because they protect you directly. Lesson 1. When no one carries the consequences of a risk, that risk explodes. Banks went wild precisely because they sold their loans and kept none of the danger. This is called moral hazard, and it appears everywhere in life and money. Always ask, who actually pays if this goes wrong? If the answer is not the person making the decision, be very afraid. Lesson 2. Complexity is often used to hide danger, not remove it. Those CDOs were so complicated that even the experts didn't understand them, and that was the point. Genuine safety is usually simple and transparent. When an investment is so complex that no one can clearly explain how it makes money or where the risk lives, that complexity is a warning sign, not a sign of sophistication. If you can't understand it, don't trust your money to it. Lesson 3. Nothing is guaranteed to only go up, ever. The entire crisis rested on the belief that house prices could never fall. That one assumption, treated as an unbreakable law, turned out to be false, and it took the world down with it. Whenever you hear that some asset, whether housing, stocks, or crypto, can only rise, remember 2008. Markets are cyclical. Prices fall. Any plan that depends on permanent gains is built on sand. Lesson 4. Leverage is the accelerant in every financial fire. Banks and homeowners alike had borrowed enormous amounts relative to what they actually owned. So when values dropped, even a little, they were instantly underwater and wiped out. Debt magnifies everything, your gains in good times and your destruction in bad times. The more borrowed money sits underneath a system, the more violently it shatters when the trouble starts. Respect debt. It is never as friendly as it seems. Lesson 5. The herd is most dangerous when it is most confident. At the peak, almost everyone, from homeowners to the smartest bankers to the rating agencies, believed the good times would last. That shared certainty is exactly what allowed the bubble to grow so monstrously large. When you notice that everyone agrees an investment can't lose, that unanimous confidence is itself a red flag. The crowd is usually most wrong at the very moment it feels most sure. Lesson 6. The most personal one. Protect yourself, because the system will not always protect you. Keep an emergency fund so a sudden shock can't ruin you. Don't borrow more than you can survive losing. Diversify, so no single collapse can erase everything. And never assume that because something is widely accepted as safe, it truly is. In 2008, the safest seeming things became the most dangerous. Your own caution is the only safety net you fully control. Looking back now, the 2008 crisis feels almost unbelievable. A disaster built from boring home loans, inflated by greed, hidden by complexity, blessed by corrupted ratings, and supercharged by debt, until it nearly took down the entire world. It was not a natural disaster. It was a human one, made of millions of small decisions to ignore risk in the chase for easy money. And that is precisely why understanding it matters so much. Because the specific details change, but the human patterns never do. Greed, denial, complexity, her behavior, and the seductive belief that this time is different, these forces are always present, waiting. There will be another bubble and another crisis. The names and the assets will be new, but the story will rhyme with this one. The people who understand 2008 are the ones most likely to see the next one coming, and to protect themselves before it hits. So the next time you hear that some market can only go up, that a complicated new product is perfectly safe, or that the experts have everything under control, let the ghost of 2008 whisper a little caution in your ear. Stay curious. Stay skeptical. Understand where the risk really lives and who pays when it goes wrong. That awareness is one of the most valuable financial skills you can ever build. It costs the world dearly to learn it. If you made it all the way to the end of this one, thank you, seriously. This is exactly the kind of deep money story we live for on this channel. We break down the biggest financial disasters, frauds, bubbles, and comebacks in history, and pull out the lessons that keep your own money safe. Subscribe to Money Stories, ring the bell, and tell me in the comments, do you think another crisis like 2008 is coming? I'll see you in the next one.